A very good afternoon to everyone. As we all know that financial reporting is an important tool in the hands of the entity. It contains vital information about an entity's health. With this, I would like to welcome all the participants in today's series of webinar on excellence in financial reporting, lessons learned, best practices, and commonly found errors, specifically in the insurance sector today. We have amongst us the presence of the dynamic chairman of research committee, CA Dr. Anuj Goyal sir, and before going forward, I would like to give a brief introduction about Anuj sir. I would like to also mention that Research Committee ICI is blessed to work under his able chairmanship. CA Dr. Anuj Goyal is a practicing chartered accountant and the Central Council member of the Institute of Chartered Accountants of India. He has made a significant contribution to the profession with his extraordinary tenure of 17 years in Central Council, 3 years in Regional Council, 6 years in branches, including chairman of Central Indian Regional Council, chairman of various ICS central committees, member of the editorial board, and so on. He is a self-motivated and enthusiastic and hardworking person who has proved to be a great source of motivation specifically for the youth. His contribution in the field of research and development has always been remarkable. Now, I would like to request CA Dr. Anuj Goyal to please address the participants.
Thank you, CA Neha Bansalji. I welcome all our honorable delegates on behalf of the Institute of Chartered Accountants of India and on behalf of the Research Committee of the Institute of Chartered Accountants of India. And I welcome, of course, our very, very prominent resource persons, CA Ankit Maheshwari sir from Jaipur and CA Kuldeep Kothari ji from Delhi. I think the way both of them are contributing for the cause of the profession, and particularly in the research committee, I think something really great. And friends, as we are very well aware that we are having a series of webinars on excellence in financial reporting, lessons learned, best practices, and commonly found errors. And you are very well aware that since 1958, since last more than 65 years, we are having that ICI Award for Excellence in Financial Reporting, in which best of the corporates from each and every sector do participates in the ICI Award for Excellence in Financial Reporting. And out of the lessons learned out and the best, we are having this series of webinars. And today we are covering very, very important insurance sector. And we are very well aware that 20 years back, Insurance and Regulatory Development Authority, IRDA, came into existence. And after that, the scenario of the insurance sector is this, that the monopolistic hold of the government has come down, and now a lot number of private sectors, private players, including foreign players, are now there in the insurance sector. So for the ICI Award for Excellence in Financial Reporting, we are having a separate sector, insurance sector, and life insurance as well as non-life insurance sector, in which both government supported entities as well as the private sector entities are participating. And we are very, very happy that we are having the best of the resource persons to guide us that how we are supposed to take care of our financial statements of the insurance sector in the new scenario. And we are very well aware that now 76% FDI has been allowed in the insurance sector. Earlier it was 51%. So now it has been opened like anything as far as this insurance sector is concerned. And as far as the financial part is there, I think the members of the Institute of Chartered Accountants of India, whether they are working with the insurance companies or they are rendering services as auditors, I think the role of both the sides is very, very important. First of all, I think each and every chartered accountant who is practically responsible in the preparation of the financial statement is supposed to understand the nitty-gritties which are supposed to be there as far as the insurance sector is concerned, because now whether it is Ind AS, whether it is whether it is auditing standards, whether it is ethical standards, now we are at par with the international standards. Practically, whatever International Federation of Accountants (IFAC) has mandated, we are practically following now in India. So our chartered accountants are supposed to be very well versed about all those requirements, and I'm quite confident that as we are having the best of the resource persons, they will certainly try to see that how our chartered accountants and other finance professionals can really justify with the responsibility which they are having. And friends, you must be very well aware that since last 3-4 years, we have taken n number of initiatives as far as the research committee is concerned. We are trying to see that how Institute of Chartered Accountants of India through research committee can be global. We are having very prominent secretary of the committee, Dr. Amit Agarwal ji, under whose leadership we are trying our level best to have best of the initiatives. We have taken one initiative of ICI International Research Award. This is the 4th year of the initiation of the ICI International Research Award. Incidentally, first International Research Award was amidst the Corona, and in spite of Corona pandemic, we implemented it in a very successful manner. And in the very first year, second year, third year, the president of International Federation of Accountants (IFAC) was the chairman of the jury for the ICI International Research Award. And this time, we are going to organize this ICI International Research Award at the best of the location for the members of the Institute of Chartered Accountants of India outside country. In the Gulf countries, we are having very strong presence of around 20,000 chartered accountants in the Gulf country.
I think Neha, we lost his voice. You have to call in.
Yes, I think there is some technical.
And we intend to have it in Dubai this time. I'll request all the delegates to be the part of this ICI International Research Award. We are going to have it somewhere in October in Dubai. And then we have initiated ICI research project scheme, in which we are trying to see that how our chartered accountants can really do something very concrete, not only for the accountancy profession, but also for the society, for the nation. And number of chartered accountants have come forward, and under this ICI research project scheme, we do reimburse up to 10 lakhs of rupees to the researchers, and we are having very strong selection committee comprising of the past presidents of the Institute of Chartered Accountants of India. So I will request all of you to see that if you are having that mettle to be the part of the ICI research project scheme. And in addition to that, for the young chartered accountants who want to go for the research on full-time basis, who want to do a PhD on full-time basis, we are now having the provision of scholarship of 75,000 rupees per month, which was earlier 50,000 rupees per month. Up to 3 years, we are having that provision of PhD on full-time basis, either sitting at ICI office or sitting at the university office on full-time basis if a chartered accountant want to pursue PhD, and it is on the subject, on the topic which is of the interest of the profession. We will certainly shortlist that for the ICI doctoral scholarship scheme. I will not be taking your further time, as we are very eager to hear our honorable guest speakers, very prominent resource persons, CA Ankit Maheshwari sir and CA Kuldeep Kothari ji. And I once again welcome all our honorable delegates on behalf of the Institute of Chartered Accountants of India, on behalf of the Research Committee of the ICAI. Thank you very much, friends.
Thank you very much, sir, for your valuable insights. And we have amongst us the eminent speakers who are a great source of knowledge for all the participants, CA Ankit Maheshwari and CA Kuldeep Kothari ji. CA Ankit Maheshwari is a highly accomplished and dynamic chartered accountant with an exceptional track record of over 15 years of experience in various geographies. And CA Kuldeep Kothari ji is a fellow member of Institute of Chartered Accountants of India. He has expertise in the field of FR framework, ESG reporting, direct and indirect tax litigation, investment, startup consulting, etc. Now, I would request both the speakers, CA Ankit Maheshwari ji and CA Kuldeep Kothari ji, to please start with today's session.
Thank you. Thank you so much, Neha, for warmly introducing us. Let me first place my thanks to the chairman of Research Committee and the Peer Review Board, CA Dr. Anuj Goyal sir, for, irrespective, he's traveling to all parts of the country. He never misses out addressing his members, and that is his commitment since last, as Neha was rightly introducing, since last 25 years. Sir, I think nobody like you can serve the profession. And very rightly said that I think, sir, the entire profession, the backbone is research only. And unless we research hard, unless we have that metal, the word which you used, I really appreciate it. I think we have to, we have to be thick-skinned. We have to make sure that we are able to deliver in terms of research to the world. And we are very happy to know the initiative of ICAI Research Awards, which are happening in Dubai. And we are sure that, sir, you will find a lot of participants coming up there, delegates coming up there, and it will be a great event. But thanks to you for, sir, always encouraging us, motivating us, making sure that we have this kind of a series where we covered all the sectors. I also want to place my thanks to Dr. Amit Agrawal ji, Secretary of Research Committee. And as rightly highlighted by our chairman, sir, he's the man behind, meticulously organizing these sessions. Neha has been constantly working with us day in, day out. And Neha, I always would want to, say that it is the ground level effort and everything, seamlessly managed by research committee. We are highly thankful to you. Finally, I want to place my thanks to my co-speaker and a dear friend, CA Kuldeep Kothari ji, who is also been extensively traveling and taking these sessions. I am sure that together for next 1.5 hours, we'll try to add a lot of value on the entire sector. Respected chairman already, set the tone in a very fair way, saying how we are integrating or how we are, converging to NDS, and insurance sector is one sector which is now looking up to this convergence of NDS. There is a lot to do on that front. We are still majorly complying to the master circular which came in 2002 and then was further revised in different phases. But when this NDS is applicable to insurance companies and the banking companies, I think there will be a lot of transition which we have to undergo together. And Institute's research committee will have again a lot of role to play dissecting the kind of problems these transitions takes place. Today, we are here to deliberate on commonly found errors in insurance sector in their financial reporting framework. And we'll try that, we stick to the financial part also, Kuldeep ji. I would also want to say that let us, dissect the entire non-financial part also, which has become an integral part of the entire reporting framework of these companies, be it the integrated reporting, be it the sustainability reporting, be it the other aspects, because insurance companies are, I still feel these are those important stakeholders of the country, wherein a lot of insight should have come from, be it IRDA, be it government, be it institute. But somehow these companies, because of the complexities, are left behind providing insights. So we both are very excited to have a deliberation with all of you. I know it would be a very closed group audience. So I would always say that let us try to keep it interactive. Let us try to have our chat boxes open. Let us try to pose maximum queries and to the best possible of and maximum knowledge we both possess. We'll try to solve it. Let me share the screen. Let us come up with the presentation straight away and let us try to dissect what is happening in the financial reporting framework of the entire country and then narrowing it down to the insurance sector, be it general insurance, be it other insurances. And let's try that we gain maximum perspective, be it on IRDA, be it on LODR, be it on accounting standard, and be it maybe getting future ready with Ind-AS. That shall be the objective of the entire next 1.5 hours. So I'll just share the screen. Kuldeep ji, just let me know, if you're able to see that. Is it visible?
Visible, sir.
Okay. So Kuldeep ji, while we talk about, excellence in financial reporting, I think the first thing which we should talk about the quality of financial reporting and how does this quality is monitored at institutes level, which is our internal mechanism, and how the quality of this financial reporting is measured by the external agencies. And it is important that we dissect either be it we are on auditor side or we are on the company side. A lot of thrust has been, given on quality mechanism of our institute also and the external agencies as to how they are intervening and how they are monitoring this quality. So, friends, our institute has 4 very critical boards measuring the quality of the financial reporting. Can anybody name me those 4 boards? I am repeating my question. And Kuldeep ji, if you have access to the login, I am repeating my question. Our institute monitors financial reporting quality and the quality of the audits, which we do through 4 very important boards. Can anybody tell me in the audience which are those 4 boards which I am here referring to? Kuldeep ji, if you find an answer,
Sure,
let me know.
As of now, nobody has replied.
Okay. So let me go into this. Let me go detailing these 4 important boards and how they are functioning and how do they impact the functioning of an auditor, of a person who is working in corporate reporting teams or financial reporting teams of an entity, and eventually how your financial reporting framework is reviewed. So let's try to find it out. Our institute is blessed with 4 very important boards, and all of these boards are monitoring the quality. The first board is your quality review board, which in January 2019, when NFRA came, vested with NFRA and became independent in persuasion to excellence in quality of the institute only. However, this board functions and oversee the quality of the financial reporting, which and the auditors reporting, which which can be subject to review by NFRA. It's a very important board. It primarily focuses on the principles followed by auditor and the objectivity of the auditor in auditing the financial reporting framework of a particular company. Then you have your financial reporting and review board, and your FRRB was constituted in July 2002 in 226th council meeting. As the name suggests, FRRB is primarily responsible for looking at the quality of the professional and technical standards implemented by the auditor or the company. So what happens here is that FRRB handpicks 10 companies, 5 companies of insurance sector or any sector and starts dissecting the non-compliances specific with respect to the standard of auditing and the accounting standards or the CARO or the Companies Act or all those regulations which are applicable in India. And when you look at FRRB's report, you realize that the kind of errors FRRB is able to highlight is very basic errors, is very generic errors. And such errors are, very commonly taking place. With respect to insurance companies, yes, we will cover the important errors which have been highlighted by FRRB. But even with respect to other companies, you will realize that the auditor sides really needs to gear up into this. If they are auditing for any entity in which public at large is vested, to avoid these minute errors. For example, Kuldeep ji, I was going through that FRRB recommendations. We realized that there are certain errors which are as basic as something which you cannot expect. Example like pertaining to valuation of inventory. So while your AS2 or your Ind AS 2 clearly mandates that inventories needs to be measured at cost or NRV, still even the large companies are using the average cost method and also making it a part of their accounting, not say, but for other companies, a very basic error was highlighted, like the terminology you use for cash flow statement. So FRRB highlighted this point that cash flow statement is not cash flow statement, but as per Indian accounting standard, we write it statement of cash flow. On auditor side, even the large listed companies, right? Certain auditors' balance sheets went without signatures or mentioning SD, which again became a issue for FRRB. The incomes which like dividend incomes or interest incomes, they still become a part of operating activities when we show cash flow statements. Should have been a part of investing or finance activities accordingly. So when you look at these errors, my suggestion to my learned audience here is, I think we should, if you are into assurance practice, if you are into corporate reporting, I think the first thing which we should look at it as is the FRRB's modules and publications, which finds out this commonly found errors in financial reporting framework. So that will give you a lot of perspective related to it. Then thirdly, we have the peer review board, and our chairman of research committee is fortunately chairman of peer review board also. And I would tell you from auditor's side that institute took a very strong stand in taking a mandate of peer review. SEBI took this stand way back in 2010, and all the companies which are listed on a recognized stock exchange were expected to go through this entire peer review process to ensure that the quality of financial reporting which comes from auditor side is excellent. Now institute in last year took a mandate that a 5-year 5-partner CA firm needs to be mandatorily peer reviewed on or before 1st April 2023, which they eventually extended it to 31st July. Next year you see 4, next year you see 3. So in next 3 years, almost 70% of the firms which are practicing, which are auditing for listed entities, shall be mandatorily peer reviewed by the peer review board. And I would want to highlight 2 very important things. One, as of now, three listed insurance companies have been found to get their financial reports prepared by auditor or audited by an auditor who is not peer reviewed. So already there is a violation in the norm, because as I told you in the beginning only, SEBI mandated this way back in 2010, while they were saying that a listed company needs to be audited by a peer review auditor. My request to all insurance companies, corporate reporting teams present on this session, that make sure that your auditors, if they are Indian auditors, they are mandatorily peer reviewed. Otherwise, it is the violation of not only the SEBI guidelines, but also the institute's mandate, irrespective of the size of the firm. So I feel that there is a lot which will be in times to come, which will be done for the quality uh, perspective, and those chartered accountants who adhere to all these quality will only survive in next 5-7 years in assurance practice. My request, if you are into assurance practice, please make sure that you mandatorily get yourself peer reviewed. Don't skip out of this process of peer review, and eventually then only you are able to audit for a banking or a listed insurance company or something like that. So that gives you uh, a platform. Uh, the next board is the Tax Audit and Quality Review Board, and where an audit is done by IRDA or by RBI or by SEBI or by CBDT or by CBIC. If that audit is instigated by these boards, then they approach our Tax Audit and Quality Review Board to eventually make sure that the quality of information you are furnishing to IRDA as an insurance company, to banks as for RBI for bank. So all these financial reporting is monitored through these four boards. Kuldeep ji, I would want to tell my fellow chartered accountants, those who are in industry also, that there are certain openings for empanelment as technical reviewers in all these three boards, be it Quality Review Board, be it FRRB, and Tax Audit and Quality Review Board. Rather,
there is-
FRRB, yes, please.
Sorry
Kuldeep
to
ji.
interrupt. There is a question related to what you are deliberating. That what are the areas which are generally covered under QRB?
Okay, I'll address that question. So the first thing which I am wanting to tell you is that there is a technical review vacancy, and if you are a technical reviewer with QRB, for every report you review, you get 1 lakh rupees. But most importantly, what I and Kuldeep ji learned out of this process of being reviewers on all these 3-4 board is the perspective you get when you deliver to your client. So that is where I feel that we have to come volunteer ourselves also to be empaneled into these boards. Institute also requires that kind of capacity, that they have maximum reviewers. All these three boards are open for technical review and pay you also, and gives you perspective also. Now coming back on Kuldeep ji's question, so Kuldeep ji, Quality Review Board, while it was constituted by the institute only, the focus was on the audit documentation, or the quality of audit done by the auditor. And so generally a Quality Review Board is initiated on a chartered accountant firm who is auditing a entity on in which large public interests are vested. So if you are an auditor for, say, SBI Life Insurance, or even a non-insurance company, there is a high probability that a QRB can select you as an auditor firm, as a practicing unit, and want to check the quality control mechanism of your entire firm. Now, when that happens, I think there are 3-4 things which you should be ready with. One is AQMM, one is DQMM. So when I say AQMM, to all auditors sitting here, I want to say, if you are auditing for an insurance company, it is mandatory that you now start preparing an AQMM. This AQMM is a 600 marks checklist, is a self checklist, and this will only strengthen your quality control as a practicing unit. Similarly, there is a digital competency quality maturity model. And that talks about the digital competency of the firm. So when this QRB is done, sir, your AQMMs, your digital competency will be seen, your audit documentation pertaining to each file will be seen, your most importantly, your SQ compliance to SQC. And nobody deliberates on SQC1. But I am telling you that standard of quality control itself talks about a lot of things. What kind of manuals you have in your office, the practice manuals you have in your office, what is your policies, what is your quality control mechanism, how your engagement partners are independent, everything. It is, I can tell you, it is like 80% of the investigation. Before NFRA coming up, it was not that difficult. So because it was internally done, so it was as you know, as lenient as peer review. But with this, with NFRA coming up, now we have an independent agency monitoring it. Rather, the findings of QRB by NFRA, Kuldeep ji, there's a Supreme Court judgment, rather Supreme Court petition, I would say, on this, where NFRA has come up with the point that if a chartered accountant firm is found to be non-compliant with QRB, then a separate investigation needs to be taken on the company, and these proceedings will not be governed by the disciplinary mechanism of the institute, rather by QRB themselves, rather by NAFRA themselves. I would also want to add two important things here. One, I think everybody in this audience should, I hope I answered the QRB question that what all is the scope, and it pertains to the audit quality majorly. But I want to put up two important points. One, I think everybody after this session, please you look at the NFRA's website and you will find a lot of advisory from NFRA coming up, not only in compliance to Ind AS or accounting standards, but also in compliance to the other enactments. They have broadened their scope. They have constituted a parallel board, just like our board of financial reporting and review. We have a FRQRB board, financial reporting and quality review board, and it is offering a lot of advisory on it. Two, before that, before last 2-3 years, if you were found to be non-compliant or less on quality by these boards, Kuldeep ji, there was no disciplinary proceedings which were happening out of it. Now the problem is when these boards highlight the deficiency, there is a very robust disciplinary mechanism because of constant pressure by NAFRA and Ministry of Corporate Affairs that institute has to adopt. So, for example, the charges, Kuldeep ji, I was discussing of FRRB, it appears to be very basic charges, right? But all these reports are now referring to disciplinary committee of the institute for a prima facie opinion. And not only this, we have gone to an extent where the corporate reporting teams, the CFOs, the senior management, because of applicability of NOCLAR, I hope they are aware. I hope institute is able to make them aware about the non-compliance of other laws and regulations for professional accountants who are practicing who are in industry and not in practice. This clause is also applicable, in which if you are not able to comply to any other law or regulations, any other law and regulation, then even if you are a CFO of a company, if you are at a senior reporting team, senior team of your corporate reporting team, senior team member, then these clauses are applicable. And institute and NAFRA's mechanism have now started governing into these issues. And that is when I wanted to give this background, Kuldeep ji. And that is when Kuldeep ji, approached Anuj ji and Amit ji that it is high time, either, to avoid all these proceedings, it is high time that we start educating people about the reporting practices, because the kind of deficiency found by these organizations, it is very difficult to safeguard the clients or the companies against these mechanisms. And that is the ultimate objective, that we not only achieve the excellence, but we also make sure that we are minimally compliant, right? Kuldeep ji, anything you want to add else? Let's go on the first, I would want to, ramp up the commonly found errors of FRRB with respect to insurance companies. And I would want to pose some tough questions to these audience that let's have a brainstorming session out of this, and let's see what kind of practices as an auditor you have been attesting, and as a management you have been presenting as a part of the financial statements.
I
Could it be
think we-
anything else?
I think we should start with the technical session related to insurance, because we have very, comprehensively covered all these things. And in my opinion, also, in order to achieve excellence, it is not just about looking at your financial reporting framework or financial or non-financial disclosures. It is, required to have a viewpoint from the regulator's perspective also. So
Right.
you need to benchmark with the peers with the best reporting practices, as well as you need to satisfy the requirement of regulators, be it institute or be it any other regulatory body, MCA, NAFRA or IRDA per se for insurance companies. So in my opinion, understanding all these basic things is the first step towards achieving a financial reporting framework, which is, I think, ideally free from material misstatements or any serious error. So we can start with the technical
Okay.
session.
So before I start, I have a question. I have a question to the learned audience. We are trying to dissect the irregularities which have been found in the financial reporting framework of insurance company. And my first question to my audience is a very basic question. When you prepare a cash flow statement in an insurance company, which method do you adopt?
Very
Kuldeep ji?
interesting question.
It's a very basic question. I am
Very
saying
basic question.
let's start from basics. Unless we go on the schedules of when we go by on the schedules of IRDA, I want the session to be relevant to all the audience also.
But if nobody answers, I will answer on their
Right.
behalf.
So we have to, because there's a lag in session,
Yes,
let's give them 30-40 seconds. Which method as an insurance company you adopt for preparation of cash flow statement? Question number 1. And I add question number 2 into it so that we get answers in sequence. From where do you adapt the format of preparation of cash flow statement in these companies? And then the third question is the commonly found error.
Sir, there are 4 answers.
Right.
The audience is divided in 50-50. To Ankit from Bajaj Allianz is answer direct method. Ronak from WIC is answer direct. Rahul Jain from Delhi, I guess, has mentioned indirect method. And Mr. Karan Roongta from Mumbai has mentioned indirect method.
So that is why I posed this question. Now, the correct answer to the first is that, Kuldeep ji, if you want to deliberate, you were saying you wanted to answer.
Yes, certainly. So friends, when we see the reporting framework or the applicability of accounting standard per se for insurance companies financial statement and preparation of the financial statement and reports are being governed by the IRDA master circulars. First, it was issued in 2002, then it was amended in 2012, and so on. Few of amendments have been carried out by IRD in that particular circular, in which IRD has specified various schedules and the way of applicability, how accounting standards are to be applied. So to start with, there are 3 exceptions, Ankit, which IRD has given, that
Okay.
Apart from the other accounting standards, only 3 accounting standards are covered under exception. One is accounting standard 3, that is cash flow statement. It specifically says that the cash flow statement is required to be prepared as per the direct method, rightly said by few of the members who are attending the session. And second is accounting standard 13, that is for investment. So accounting for investments and the presentation disclosure is to be specifically governed by the regulations and the method as prescribed by IRD and the master circular. And third is segment reporting. So accounting standard 17, I guess. So segment reporting is also required to be presented as per the IRDA master circular. So while I was, answering on behalf of the participants, we have got few more answers. Ankit from Bajaj Allianz has mentioned direct method and AS3 master circular. Sumit from Jaipur has mentioned direct method IRDA. Karan, Adarsh, Uttam, and Jayesh Parmar has mentioned IRDA regulations. We have answered from Yogesh Bansal. He is saying that format picked from IRDA preparation and presentation of financial statement 2002, which has been, as rightly said by you, Ankitji, has been amended and modified by 2012 circular. And we have one answer from Uttam Agarwal from Bharti Exsa from IRDA format, IRDA regulations. So I
Perfect.
think we have got the fair answers for this.
Kuldeep ji, we have a very learned because while I was searching through certain things from on insurance sector, I went through Jayesh Parmar ji's presentation also, which he gave at WIRC. He's one of the person who gave an answer to this, and it was a very well made presentation, highlighting key risks for auditors while they are auditing for insurance companies. Importantly, this comes from Annexure 3 of the Master Circular. That is where the format comes from. And now we come on the first issue. And the first issue talks about, where the companies not disclosing government securities, government guaranteed bonds, and treasury bills as separate line items in cash flow from investing activities. Which means, Kuldeep ji, when you look at FRRB's advisory on this, and when you study it into detail, they are saying majority of the companies are showing their net investments, net investments. Whereas the master circular clearly says that company has to disclose it as separate line item if they correlated with their investment schedule only. So they found that they hold these kind of investments. So if you are preparing, if it is being a direct method, then any cash flow arising from loan disbursements or investment in money market and liquid funds must be also reported as cash flow from investing activities, and there has to be separate line items for all the securities which we were discussing. The next, I hope this is clear. I hope, and that is, Kuldeep ji, when you said that this entire accounting standard framework is applicable, barring three important standards, which is like cash flow statement and your accounting for investments and segmental reporting. So you realize that advisory has come on all these three standards separately, right? Now, the next pertains to how do you disclose your foreign agency balances? And when we talk about foreign agency balances in your schedule 2, which is advances and other assets, and then we have another advisory on advances and other assets, which Kuldeep ji will deliberate when we move ahead in the session. But the question here is that balances pertaining to foreign agencies have not been presented separately in this schedule 12 of advances and other assets, where we are disclosing the agent's balance also. There has to be a separate line item which is in requirement to part 5 schedule B of the IRDA, and it has been found as a serious non-compliance by FRRB. Kuldeep ji, anything you want to add into these 2 points, or any question our audience have?
Right now, we don't have any questions. I think the first point is pretty much clear, Ankitji.
I think they are both self-explanatory points.
Self-explanatory, because the accounting standard in itself, accounting standards or Ind AS or AS says that netting of activities while presenting in the cash flow statement is governed by the accounting standards specifically. And when it comes about insurance sector, And when it is specifically mentioned by the regulator that it is to be reported in a way, it has to be reported in that way only. So first error is, I think, pretty much well understood. And when we talk about the second, non-compliance which FRRB has observed, or observation that they have given, basically foreign agency balances, can include your premium receivables or your premium payables when you are getting your a reinsurance.
Even
from
claims.
yes, claim also. So when you are getting a reinsurance from a company which is situated outside India. There was a question from Ronak also. Ronak, we are addressing your query itself. Foreign agencies means that when your business is conducted outside India, say premium is being collected outside India, or commissions are being paid. So it can include a premium payable, premium receivables, commission payable, commission receivables, as well as claims which are required to be paid. So basically, these transactions take place in a other denomination currency. And as per the regulations of IRDA, Part 5, they are to be reported as a separate line item in the Schedule 12, of which is advances and other assets. And that was, I think, as you rightly mentioned, Ankit, it is a very serious non-compliance which was being found in the financial state. So you can carry on with the third.
Right. So the third pertains to, as I told you, is the segmental reporting part, right? While we talk about premium deficiency and policy pertaining to premium deficiency, friends, it is being found that companies are providing this accounting policy, and this is an illustrative example of an accounting policy which is for a premium deficiency, which is on your screen, and which talks how the net premium is compared with net incurred claims. Eventually, the point which we want to highlight here is the premium deficiency in reportable segmental account. So this company for which we are discussing, right, it has segmental revenue accounts of motor DR pool also and aviation segments also, but they did not included this premium deficiency as a separate line item when they were segmentally reporting it. So this is again a non-compliance to the circular, which we have been deliberating as of now about. Kuldeep ji, do we have any questions?
No, right now there was one question from Ronak. He has asked that about the second commonly found observation that we discussed, that does it include foreign reinsurer? Yes, Ronak, it includes foreign reinsurer also in foreign agency balances. And there was one question I am not able to understand from Kumud Chakravarti, that can we get a copy of the prize winner accounts in our personal email ID and list of common mistakes noticed in different audit reports? Ankit ji, would you like to answer the second part of the question, list of common mistakes?
So I think we will try to circulate to Neha, and if Neha can circulate it to the audience, we are happy that maximum information is provided from our side. And there are certain, because this is what FRRB observed, and you will be surprised to know that I told you this board was constituted in July 2002. We are in 2023, and these are only 3 advisories which came from FRRB. But while we advise to all the most of the insurance companies on the common pitfalls, I and Kuldeep ji were able to find few more pitfalls, which we will discuss in due course of the entire mechanism. So don't worry, these are not only 3 things which we are deliberating on, but I also want to highlight an important thing, that we have to also talk about the entire financial reporting framework. To understand it, I think we now have to, so the FRRB thing, the internal advisory ever received from Institute on Insurance in relation to financial reporting practice has already been discussed. Now, let us look into the external advisory, and also let us look into the experiences which I and Kuldeep ji jointly had with these insurance companies while reviewing their financial reporting framework. So, as of now, I want to dissect three important laws, which is your SEBI LODR regulations 2015, your SEBI prohibition of insiders trading regulation 2015, and the non-compliance of buyback regulations, or for listed companies, the non-compliance of ICDR. In all these 3-4 cases, in all these 3-4 regulations, you find a major non-compliance and major advisory constantly coming up from SEBI. So when you talk about financial reporting framework, you have to, for all those listed insurance entities, I think this is something which we should look out for. And Kuldeep ji, I want to highlight one thing. So when insurance companies were seen non-complying to these regulations, maximum cases pertain to two things which were highlighted by SEBI. One was RPT, which was pertaining to related party transactions, where majority of the companies are not able to disclose the nature of the transaction. Rather than just disclosing a related party in your RPT note will not suffice. You have to disclose the nature of the transaction. For example, there is an advisory as to how do you reflect compensation of your key management persons when you are complying to AS accounting standard of related party. Lot of companies fail to bifurcate this compensation into, they generally write sitting fees, commission fee, or something. There's a clear advisory of mentioning it, like, the short-term benefits you derive from it, the other long-term benefits you derive from it, and then you have to categorize your fees as per the accounting standard which have been received. So a lot of advisory comes on RPT when the parties fails to disclose the nature of the transaction, or sometimes companies fails to disclose the name because they have not entered into any transactions with related party. So irrespective, a commonly found error, even if you or company or has not entered into any transaction, it shall become a part to your accounting standard. Also, an advisory came when we were discussing the related party transaction, that auditors certify that they have certified the related party in compliance to CARO. There, auditors have to mandatorily mention the reference of accounting standard that they have certified it as per the accounting standard of related party also. So this was highlighted by FRRB, but this is something which is also seen with respect to the insurance companies. The other is your Ministry of Corporate Affairs. And as I was telling you, your CARO, or be it your NFRA, or be the accounting standards which are issued by ICI. Also, to all my friends from insurance sector, I think we have been deferring the Ind AS. Kuldeep ji always talks about to all the insurance companies. He, gives advices to that. Now is the time that you should start giving a separate note in your accounting policies for, how are we implementing the entire framework of Ind AS. Kuldeep ji, anything you want to highlight? The point which you made to a client, I remember about, mentioning in their financial reports, annual reports, as to the accounting policy, as to their measures they take for adoption of forward-looking practices.
See, Ankit ji, as you have rightly mentioned that I think the implementation of Ind AS 117, or you say IFRS 17, I think it is on the verge of being implemented in India, because globally it has been implemented from the first of this year. So sooner or later, we believe that Ind AS 117 will also be applicable, and if I am not wrong, the IRD has geared up for this also, and like the banks are presenting from 2018-19 pro forma financial statements on as per Ind AS on half-yearly basis. The IRD has asked the insurance companies to prepare the same on half-yearly basis. So make them ready for the transition that is going to come. It will be a major shift in the insurance sector because there is no as such technical upgradation or technical change apart from circulars which are being issued by IRD, and I think it was well required also. So while or up till the time it is not being implemented, it is being advised. So if you see a reporting practice which is forward looking and which is excellent financial reporting practice, Ankit, one has
Right.
to look into the future, and one has to prepare the report or the statement around the future. So it is good, or it is a very good practice for companies specifically which are listed to give a note related to how they are preparing for the implementation of Ind AS 117 as and when it comes, and regarding the changes or impact which is going to be seen in the financial statement after the applicability. Over to you, Ankit.
Kuldeep ji, I have this question too, because I know we were hearing something from Bajaj Alliance also, we were hearing from Bharti AXA also. My questions to my friends in insurance industries, how many are giving this note in their annual reports? I wanted to know the answer. How many of you are giving this note on the practice of adoption of this particular Ind AS, which Kuldeep ji is referring to?
No answer yet, Ankit.
I am sure there would be certain companies, because
Yes,
I
yes.
have reviewed. I have reviewed balance sheet of certain companies, of them only. Any answers?
Let me see.
By the time
Not-
answer comes, I think I would want to conclude this entire slide saying that eventually it is a very small or an insignificant mistake which SEBI or non-compliance of LODR, SEBI picks up for non-compliance of LODR. But eventually, when you look into this entire scenario, so a small mistake, the repercussion is your NFRA, your QRBs, your SFIOs, your IRDA, everything gets activated. So importantly, please make sure that you reduce this threat at ground level itself only, complying to the basic guidelines which SEBI has issued. Also, as I told you, two advisories came from SEBI. One was on RPT, and the other is delay in filing of information by SEBI in compliance to LODR guidelines. So sometimes even you have complied to, but the time frames are breached. So make sure that this timely circulation of information uh, is given. Kuldeep ji, now we received any answer?
There are two answers. Mr. Lavesh Pagaria from Mumbai has answered that Kotak Life has included in its notes to accounts. And
Fantastic.
Uttam Agarwal from Bharti AXA has mentioned that it is required now by IRDA. Also, we have to update board in every board meeting. So I think it is on the same line as the banks are doing since last
Correct.
5-6 years. There were one more question which
But
came.
Okay.
Sorry, apologies.
No, please.
There was one more question which came from the Mr. Ronak. He asked about that if the premium is collected in India, but the reinsurer is situated outside India, will it be included in foreign agencies? So Ronak, if you consider it as a journal rule, it will not be considered in the balance of foreign agencies account in the balance sheet. But there is exception to this journal rule if the reinsurer is is having a provision in the contract or the agreement that it can collect the premium directly from the insured. In that case, it may be included in the foreign agencies balance. There is one more answer from Mr. Jayesh Parmar. IRDA has informed insurance companies to disclose in their notes to accounts on their readiness and update on Ind AS 117 reporting. I think Jayesh ji is also on the same line on which we were discussing that there are two aspects to look at this particular note. One is being future ready, and other is complying with the instructions of the regulator. Over to you, Ankit ji.
Perfect. So now we move on the LODR regulations, and a commonly found error while all these listed companies uploading their quarterly presentations or quarterly results. My question to the audience here is that whether quarterly presentations results, everybody knows those who are listed entities. For others, I am saying whether quarterly presentations are mandatorily required to be uploaded. My question to all those listed companies, corporate reporting team, and their auditors, whether quarterly presentations are mandatorily required to be uploaded.
No answers. Yes, Ankit ji.
I think it will take some time because Kuldeep ji, I want to come out with NSE's advisory dated 15th March,
Hmm.
right? On the same, on how do you upload your investors presentations, and a serious non-compliance has been found by SEBI pertaining to uploading the quarterly results and investors presentation. My basic question to the learned audience, my friends, is whether quarterly presentations are necessary to be uploaded.
There is one answer from Ronak from Delhi. He has answered yes.
Yes, Ronak, I think you have fairly dissected it, and lot of insurance companies, I don't want to name them, are just uploading their quarterly results but not uploading their investor presentations. LODR guidelines clearly mandates these companies to, they have given certain conditions and circumstances in which you have to mandatorily upload investor presentation. More importantly, when you look at industry as a whole, I think companies have really moved ahead in sharing information with their stakeholders. And lot of companies, even when SEBI did not mandate it to upload the investor presentations, were voluntarily presenting it. And today we have come into an era that you have to mandatorily upload an audio transcript. Rather, Kuldeep ji, I was witnessing with you only the report of Tata Steel's integrated reporting, and to
Super.
all those insurance companies who are there, who are into corporate reporting, the teams who are into corporate reporting, my request will be that go through Tata Steel's AR/VR report, which is your virtual reality, and how they take you to the entire journey of their annual report through simulations. So this is not mandatory. So there are certain things which are not mandatory, but as per reporting practice, they becomes the best standard. So you will not. They were the first company, one of the first companies in India to present a AR/VR report. Last 2 years, we were talking about the audio transcripts. Tomorrow, you might find a lot of changes into this entire scenario. I want to come on the topic of finally the advisory which NSE has
NSE
issued.
is issued.
Kuldeep ji, allow me to, just
Sure,
go
sir.
through the screen, which gives this clear advisory. My screen is visible.
Yes, yes, clean.
I present it again. So Kuldeep ji, there this advisory came on 15th March 2023 of manner in filing financial results under Regulation 33 of SEBI LODR. And I hope this is visible. So commonly what companies are, the problem statement here is companies upload their investor presentations along with their quarterly results and auditors report together, with which NSE has raised an objection and has issued this circular. So this clearly talks about, I am reading the third paragraph of this circular, which says listed entities are requested to know that the PDF of outcome of board meeting held to consider and approve financial results must only include financial results, auditor's report, and other statements as prescribed under Regulation 33, Part A. If company wishes to disclose, now this is because this is a circular by NSE, so they have used this word wishes to disclose. Otherwise, a company is mandatory to disclose their investor presentation, which is not a mandate of NSE. So this has to be done through a separate announcement. So biggest of the biggest companies, Kuldeep I have seen doing this common mistakes for which this advisory has come upon. Anything else you want to add?
No, I think you have perfectly summed up. There was one answer from Nitin Tripathi from ICICI Lombard also. He said that ICICI Lombard, we are uploading quarterly presentation along with the results. And Nitinji, if I take the literal meaning of what you have written is, I think it is the same thing which Ankitji just has discussed, that it is required to be uploaded, but not along with the results. So Ankitji, basically what I understand from this circular of NSE is that, see, investor presentations are required for giving insight about the company's operation to the investor analyst also, as well as the stakeholders. And for that very reason, the companies have started, uploading results along with the investor presentation. And somewhat, the regulation says that your results, which are to be uploaded on a quarterly basis after LR, has to be, has to come out specifically in particular uploaded files. So what was happening, investor presentation was being uploaded in the first instance, along with results for appended with that file. An investor presentation was of say 30-40 pages and results were of 3-4 pages. So the basic intent of the regulation 33 was taken out, and that is why NSE has come out with that particular circular.
Perfect. So we move ahead to this, right? And then we will cover the other aspects also, the corporate governance related issues, or what are the deficiencies which are found in the board report of these insurance companies. RPT, I think I have fairly deliberated on. Let's move on the next slide, right? And as I told in the beginning only that, SEBI has been, it is the root cause. I still feel for all the non-compliances, SEBI has been a root cause. I would want to continue this on the entire financial reporting framework of the company. We have always discussed the financials in the beginning, and we will discuss after these slides also. But certain commonly found errors in insurance companies, I can tell you. One is let's dissect it into 3-4 sections. One is the chairman's speech and the director's report. Kuldeep ji, the idea behind dissecting into 3-4 section is that when, as head technical reviewers or field panelists, when these reports are reviewed by the research committee of the institute, they also dissect it into these 4-5 sections and gives you marks according to it, which the award process and everything, we will, if we have some time, we will conclude it. Otherwise, I would want to stay on the technical part only. One, the chairman's message constitutes a lot of marks. Now, it is not only a chairman's message. So the first mistake which we found in a lot of insurance company, where they had executive as well as non-executive chairmen, that there was no chairman's message. Instead, message from CEO or message from managing director, something like that comes up. So there is a clear mandate. If you are applying for the award, if you are complying to the SEBI LODR guidelines also, then also it talks about what should be constituted under a chairman's message. Now, The other thing is the future plans. So, what should be what should constitute a chairman's message as per LOTR is the 5-year plan, the vision, the mission, the growth plans of the company. Everything should come out. More importantly, please don't give projected numbers. So Kuldeep ji, in one of the companies, we found that a chairman's message talks about 5 years projection of revenue of something like that. No, it is about the qualitative plan which we are talking here about, not the quantitative plan. The second thing is in the director's report is the disclosure of internal control system and the business continuity plan, which is found to be deficient. Also, when we talk about the entire internal control system and the policies which we need to present it as a part of management discussion and analysis, Kuldeep ji, I would want to highlight one more thing. Lot of companies who are not listed but preparing annual reports. For example, Future generally, they are not listed. One, I would also, like I told you about Tata Steels in your sector, I would suggest you to, look into Future Generali's report. And last year they came up with a Bollywood theme, and it was a highly interactive report when you look at the entire report. Rather, Kuldeep ji, interestingly, I was talking to their CFO, Devi Dayal Garg ji. He told me that they sold 3,900 copies on Amazon of their annual reports. So sometimes you can make your annual reports interesting to that extent. My point here is that the only lacuna which I found in that report was a absence of a management discussion and analysis. For those companies who are coming up with their annual reporting framework, it constitutes a lot of weightage for your ICI Research Award, for your SAFA Award, for IFAC to have a proper management discussion and analysis. The problem is that while you look at the IFAC or while you look at the insurance companies registered at US, irrespective, even if they're not listed at NASDAQ or their exchanges, you will find them coming up with management discussion and analysis. A problem here highlighted is the segment-wise performance, which doesn't comes out. So even though accounting standard is not the AS of segment reporting is not applicable in true spirit, but you have to still bifurcate your insurance business segments and have to talk about their operating growth. You have to talk about their financial operating and financial performances along with the industry outlook should come as a part of MDA, which is a major miss with lot of insurance companies, right? Irrespective, as of now, sustainability reporting is applicable to only top 500 companies, right? I would suggest that as a company, insurance sector is some sector in which public at large is vested, and you should come out with your initiatives taken on sustainability. We will discuss sustainability in maybe 3-4 minutes if time permits. Then we have your corporate governance report, and with corporate governance report, the companies should provide a corporate governance report also along with the CSR report. One important thing, and I learned it from Kuldeep ji only, is regarding the board meetings and the non-attendance of meetings, especially in case of listed companies. So if you have your audit committee meeting, if you have your nomination and remuneration committee meetings, if there is a major non-attendance here, then as a part of good, excellent corporate governance practice, you are expected to give a reason for non-attendance by the directors of the company. Kuldeep, anything you want to add into these 3 points?
I want to add 2-3 things in MDA section and corporate governance section. First of all, you have mentioned about Future generally, Kiji. When you told me, I was not, able to believe that any company can sell 3,000 or
Their annual
4,000
reports.
copies of the annual reports, because people like us also, or they generally download it from the website or from BSC's website, and they go through the requisite information which is required by them. But it was very well presented annual report, though Future Generali is not listed, I think, and none of their securities are also listed, but still they are preparing annual report that is in a true spirit. Yes, MDA section was a miss, and I think in the present year they are coming up with that revamped
They're
section.
coming up with IPL theme this year.
IPL theme, and it will be very interesting to watch, friends, because this is, I think, when we talk about evolution of annual report in the coming section, this is one of the few examples which differentiates the kind of creativity or evolution that has taken place in preparation of annual report. You talked about sustainability, while BRSR has taken a shape, a new shape. Sustainability has taken a new shape in the form of BRSR, where top 1,000 companies are required to present BRSR report. It is also very important from the perspective of the insurance companies, irrespective of the fact they are listed or not listed. And third, corporate governance, because see, Ankit, while we see the corporate fiascos that has taken place in past few years, 10 years approximately or so, related party disclosure and the corporate governance issues were two pain points of the industry, be it a manufacturing company, be it an insurance or say service sector company. So these two things were the pain points, and if you want to achieve in reality practicality, excellent financial reporting, you forget about the awards or any other thing which we were discussing. In true spirit, if you want to achieve excellent financial reporting framework, you need to be transparent in your reporting practices, and corporate governance is one of those points. So straight away, coming on the commonly found errors, that these errors are other than what FRRB has observed in their observations, because these are based on experience that me and Ankitji have gathered together while going through the
Kuldeep ji,
annual report.
before you discuss these errors, any questions till now? Let's look into it, because now we are going on the most technical part, and whatever points here comes after reviewing at least 15-20 insurance companies' annual report and our experiences into it. This is not an advisory which comes from a statute.
There is no question as such. Nitin from ICICI Lombard has mentioned, in compliance with NSE circular, we are financial results are being filed separately, and investor presentation, including press release, separately.
Fantastic.
Perfectly fine, I think.
Now let's look into the hands-on points which you should look as a part of your schedules of IRDA and as the accounting policy. Kuldeep ji.
Thank you, Ankitji. While me and Ankitji were reviewing the annual reports from the client's perspective as well as from the reviewer's perspective, these points we have gathered on the basis of our experience and observations that we have compiled out of say 20-30 annual reports every year we review. So first point is related to reference of accounting standards, and Ankitji, as we were discussing in the beginning also,
right.
When if you see that the presentation is being governed by the master circular of IRDA, they've specified the schedules or the way it is to be reported. But accounting standards, barring the three exceptions, AS3, AS13, and AS17, all the other accounting standards are applicable to the extent they are being covered. It is here in the master circular also. So see, when you are preparing any accounting policy, when you are giving a reference to any sort of accounting standard, in terms of identification, recognition, or measurement, say impairment policy is given, say revenue recognition is policy related to revenue recognition is given. So it is must on your side that you give references, right references to the accounting standard. As we were discussing for one company, Ankitji, a day before yesterday, that they have given a wrong reference to
wrong paragraph, which says the non-applicability of the accounting standard.
So these type of error happens, because of cut, copy, paste things. Ankitji, you were trying to say something.
So I am saying I want all all the participants to answer. While you look at your insurance company's accounting policies and the notes which are given, how many of you think that you have rightly given these references? So because when we were reviewing these reports, I did not find much references of accounting standards coming up. So if you are giving it, I want to know that how, to what extent, 60%, 70%, or 80%, or even 100%. And by the time, if we have some answer coming up, so that all audience have that perspective, who are the industry leaders into providing these references. The point why Kuldeep ji was emphasizing it was because when these reports come for technical review, especially for excellence and especially for awards, right? We are not able to give them due marks because of not referring it to a right paragraph. And as a reviewer also, I am unable to link to the policy which you have mentioned, which para and which AS you are talking about or referring to, and to what extent your accounting policy is in synchronization with this accounting standard. Kuldeep ji, any answers?
No
Okay,
answers.
let's go on the next point. Because we are running short of time.
Yeah, sure.
Let's go on the next.
The next point is related to bifurcation of performing and non-performing asset, and there is a question from Lavesh Pagaria also in this particular point. Redemption receivable should form part of Schedule 8A, 8B, 8A and B as a part of investment. Why will it be shown under advances? So Lavesh, this is a practical issue that we have seen in annual report. I agree with you that investment are being mentioned in Schedule 8 of the preparation of master circular, whether investments of shareholders and policyholders, there are two type of differentiation that the companies make while presenting the same. And when when one investment becomes due for redemption or matures, it is shown under redemption receivable. But in this case, the issue was that there were some investments which were fully impaired and which was overdue for maturity, and hence for that very
These
reason,
investments were with IHFL and Diwan Housing, where the companies have gone into the process of liquidation and everything.
So for that very reason, they were taken out of that Schedule 8 and they were shifted to Schedule 12 advances and other assets. But the point here is what we want to make, me and Ankit want to make in this particular observation is that while Schedule A requires you to clearly bifurcate that your investments are performing or non-performing, vis-a-vis if there is any sort of impairment which has taken place, and by virtue of that you have shifted your redemption receivable or your overdue matured advances to Schedule 12, a similar kind of bifurcation is required to be given in Schedule 12 advances. And Kichi, would you like to add something in this particular point?
I think we are able to solve Lavesh ji's query. Rest, post session, if we can connect, we can come up with the hands-on demonstration of that particular annual report. Because yes, he's right. Generally, people show it under 8 and 8A. However, all these insurance companies have their investments with the companies which I was talking about, including, I think the Reliance name was also RCIL. Reliance was also there. You can go ahead with the next point.
So the next point is related to, as we have mentioned in the beginning also, it is related to impairment of assets. When we present a accounting policy, it is not suffice for a company's side to give that we calculate impairment and so and so. So there is a way we calculate the recoverable amount. There is a way we calculate value and use, and there is a way we calculate impairment of asset, the kind of impairment that asset has taken, that has gone through. So in a particular case, we have found that while presenting the accounting policy, the company has mentioned that this is the accounting policy of impairment of assets, so and so, so and so. But the way they calculate recoverable amount, as per the accounting standard, it was not mentioned. And anything you want to add, Ankit, in this point?
No, perfect.
Perfectly fine. So the fourth point is related to, we all know about the provisioning norms, and every company is creating provision on non-performing assets, which are being mentioned under the investment head or somewhere else. But you know that the companies are required to prepare a provision for standard assets also, I think at the rate of 0.4%, if I'm not wrong. And we have seen that in many companies, though they must have been preparing, or they must have been providing for that particular provision as well.
Provisioning it, but the
Policy was
is
missing.
what is expected
Hmm.
to be a part of the annual report. I think you can continue. Right?
Yes. Again, the next point is related to the management report. Ankitji, it is also part of the format which is specified by IRDA in the master circular, that the companies are
Right.
required to prepare a management report. And what we have seen is that it is like, when we discuss the integrated reporting, or when we discuss, visually appealing annual reports. So it is like looking good at your face and losing out at your soul. So the management report was missing, not in totality. The company specific information which is required to be given as per IRDA regulation was missing from the management report. Anything you would like to add, Ankit, in this point?
No.
I
Right.
can move ahead.
Yes.
I would like to interrupt Ronak. There is a question from Ronak regarding RPT, and we'll take it after these points, Ronak. So, Ankit, as you are aware that the companies which are into general insurance, they are required to create a third-party motor obligation pool also. And in this particular point, my view is divided, because few of the companies were presenting this accounting policy, and the few of companies were not presenting this accounting policy. But to be specific, this is a statute-based requirement which every company has to do. So my view is that, again, I am of the opinion, being optimistic, that they must have been preparing or providing for these sort of provisions, because they are required by the statute. But it is not coming out in the report. See, we all
Accounting policy.
are chartered accountants. We have passed our examinations also. It is like, no matter how hard you prepare for your examination, it is what you do in the 3 hours is matters the most, and it reflects into the results. Likewise, it is there for the financial reporting framework also. Though you are preparing, you are providing it for in your financial statement, but it is not coming out well in the annual report. It is not there in accounting policy. I think it is a non-compliance of the statute. So the last point is not the last. Last out of the many points that we have tried to compile for you guys. So it is related to accounting policy related to reinsurance accepted, because reinsurance accepted. I think in almost all general insurance companies you will find this use case of reinsurance
Reinsurance, ceded, accepted,
Hmm.
all these policies should come separately. The point
Separately.
is that,
Hmm.
and as a part to your, significant accounting policies and estimates, that is where the focus is on. Because, see, let's be honest, there is
Hmm.
nothing that we can tweak around IRDA master circular.
Hmm.
So what is required as a part of an excellent financial reporting practice, which Kuldeep ji was constantly highlighting in last 3-4 points, is how do you eventually communicate with your state policy which you have adopted to arrive to these figures, and that makes the practice excellent.
So, Ankit, I would like to add one thing in this particular point, that the companies were giving the accounting policy related to reinsurance ceded, but the reinsurance accepted related policy was missing. So, before we move on to the next point, I would like to take the question of Ronak. Ronak has asked that any pass-through transaction covered as related party are pass-through transactions considered as related party transactions. That is, the insurance company receives premium from B, related party of A, which collected from customer of B, then the premium collected by B, which is passed on to A to be reported as RPT. I think Ronak is trying to say that A is an insurance company, to be specific. B is a related party of A, and B is collecting premium from his customer and passing it on to A. So whether it will be a RPT, I think, Ronak, it will be covered under related party transactions. In my opinion, it will be a related party transaction. Pradeep from Mumbai has asked, what do you mean by company specific information regarding to management report? Pradeep ji, I think we can connect after the session. You have I will ask Neha ji to provide our numbers or the email IDs, and we connect and we can discuss separately, because I think we have paucity of time and we need to move on for the next section of this presentation. Ankit ji, over to you.
Okay. The next is, I think now let's look at the overall broader perspective of how an annual report needs to be prepared and what are the changes. And I feel insurance sector is one sector which requires maximum changes when they are preparing their annual report. Because of a separate guideline coming from IRDA. But my question to the learned audience here is that, how does an annual report evolves? And when you look at 10 years history of annual report, what significant changes do you see in an annual report, in yours annual report, or where you have been auditing an annual report of that company last 10 years? And let's try to place our thrust on those points to make these annual reports more interactive and make sure that we are able to effectively communicate to the stakeholder, and that is what it will make you excellent. So the question is simple. What changes do you see last 10 years in an annual report of your companies? Kuldeep, do we have an answer?
Not yet. Not yet. Not yet.
Okay, because we're running short of time, I'll not wait for answers, Kuldeep ji. Right. I think some key changes which we should look into here is, as I told you, one is the digitalization. And to the extent as we were discussing, the report of, Tata Steels, which talks about the AR, VR, or the simulation of a complete annual report. So a top change which we see is the interactiveness which these reports are able to create. How good, how betterly you are able to present your visual aids, your charts, your numbers, how effectively you are able to communicate it to your shareholders. Rule number one for an excellent financial reporting practice. Kuldeep ji, you were saying something?
Yes, I agree with you, Uncle Ankit ji. But what I was trying to say that when you talk about evolution of financial reporting or annual report, presentation of annual report, I think it is equal to the evolution of the mankind, because from the ancient times we have moved on to the time of Chat GPT or artificial humans, and I think the reporting per se is taking a shape where I think in next 5 years down the line, you will see the annual reports in AR, VR, or visual transcripts only.
The next thing, which I think, Kuldeep ji, which is a major mistake also, and where, when institute evaluates these reports as in technical review, is the lack of cross-referencing. So when I say lack of cross-referencing, I want to highlight two important things. One, how somebody is able to navigate your report. So in today, there are, like earlier, we used to scroll pages. Today, there are hyperlinks to everything. So if you present a note as per IRDA and you want to refer a policy pertaining to that note, that also needs to be hyperlinked to that extent, so that somebody can click here, go to the accounting policy, and when he reads the accounting policy, he gets a chance to come back to the report itself. So importantly, the navigation process also carries weightage in the eyes of research committee when you are being evaluated for the purpose of Excellence in Financial Reporting Award. As we were discussing, theme-based reporting and today with all these reporting, corporate reporting, theme-based reporting has also come. All I just want to highlight one point. Sometimes following that themes makes you de-align to the mandatory things. So make sure that the mandatory things are in place, and then the theme follows, not that the theme is the basic thing and mandatory thing comes. Yes, there's no doubt that in last 10 years we have moved towards a lot of transparency. In last few years, paradigm shift, responsibility reports on the sustainability reporting also, and 2-3 things which should make your annual report as an excellent report. One is the practice of an integrated reporting for all those companies who have voluntarily adopted, because as of now, the top 1,000 companies in this country are voluntarily expected to adopt the framework of integrated reporting. Kuldeep ji, I would not want to miss on emphasizing the integrated reporting framework, and I would also want to open up this with some of the insurance companies report. If you suggest, maybe we can take SBI, or because
Yes,
SBI is something, right?
SBI we can take.
So my question to the learned audience is, because now we are moving towards integrated reporting framework, which are these 6 capitals which we are talking about? So now we have, in next 10-15 minutes, we have 2 important topics to cover. One, the integrated reporting framework, because Institute is now giving a lot of thrust to integrated reporting framework, and some part of sustainability reporting. And we will try to cover the SBI. We will try to walk through to the SBI integrated reporting framework, so that we give you the entire horizon of things. Kuldeep ji, I want answers on it. What are the 6 capitals of integrated reporting?
No answers at I think let us wait for say 15-20 seconds. Maybe there is a communication lag also. No answer about capitals, but answer about what we have discussed, cross-linking and giving references. Gayatri from Chennai has mentioned that cross-linking and hyperlink helps avoiding internal inconsistencies within the reporting. That's why integrated reporting is of paramount importance. I think Gayatri, it is not about only about cross-linking and references. Integrated reporting is way much more than that, in my opinion, and it is of a significant importance because it is the way you are going to report in future. So Ankit, before we conclude in next 15 to 20 minutes, I would request you to open that circular also that we were discussing yesterday about that premium circular.
I got it.
There are 2 answers. One is from both are from Rahul Jain, human capital and financial capital. So
Kuldeep ji, before you take this, because integrated reporting is something which is very close to
my heart. After that,
I would say, I just want to say one thing to all the audience here. Even companies like SBI has not presented their integrated reporting benchmarking the IIRC framework. So the entire nation is not able to understand the concept of integrated reporting. To understand the concept of integrated reporting, including us, I am not saying that we are learning. Only thing which we have tried to do here as speakers to the session is referring to the history of integrated reporting. And because there is no hard and fast rule, so that is why I am saying that you have to look into the framework which IIRC has provided and then benchmark. You can't be dependent on your reporting agency to make an integrated reporting framework and make an entire value adding chain that, mentioning those 6 capitals and the inputs and outputs. What happens to materiality assessment? How do you introduce these capitals? So I would want to take 5-7 minutes on it. But yes, Kuldeep is right in mentioning that we have to, look into that circular which came. Kuldeep, just allow me a minute to, share that. Which is of accounting of premium you're talking about?
Yes, exactly the same that we have discussing the day before yesterday.
Okay, just a minute.
But I think you can carry on with the IR part. We'll take it in the last phase, I guess.
No worries. I have opened it. Just give me a minute. It is almost on my screen. And here it comes. I hope it is visible.
Yes, it is visible. It is visible.
Okay.
So basically, friends, it is about, how do you account for the premium claims or related expenses? The part 1 of schedule B of, the master circular provides for the way the premium is to be recognized. I think I need not to read it for the ones who are into insurance sector. So what anomaly which IRD has found while going through the reporting or the recognition framework of general insurance companies or FRBs. FRBs, to be specific, are foreign reinsurer branches which are there in India. So they've seen that many of the companies were reporting or recognizing premium on estimation basis. The estimation basis, some of them were doing it on actual basis. Basically, it is to be recognized over the period of contract per se when it comes about the recognition policy. But they were doing it on estimation basis, and the reason given by the FRBs for this particular issue is that there is a time lag or delay in receiving information from insurers, or they want to align it with the accounting policies of their parent organizations. So looking at all these points, I think this is very important for this present year also. IRD has decided to come out with specific guidelines on this particular topic, and they have said that they have permitted the companies to report or recognize premium on estimation basis for the 4th quarter only. The companies are required to recognize on actual basis up till the 3rd quarter, and in 4th quarter also if you are reporting on estimation basis. So if there is any difference or deficiency or change in the actual amount or the estimated amount of more than 10% plus minus, then they are required to report it to IRDA within 15 days of going through that. So basically, this is related to recognition of the premium claims or expenses, related expenses, and this was one of the major accounting changes which has taken place in past few years, and it was applicable for the financial year 22-23. So while preparing your annual report, friends, or while auditing the companies, you need to go through the same whether they followed this particular IRDA circular or not. Over to you, Ankit.
Thank you. I think very importantly covered. I'll just now straight away take them to the integrate. Any answers more on integrated reporting?
Yes, we have few answers. Answer from Jayesh Parmarji. Financial capital, human, intellectual, manufactured, natural, and social capital. I think is spot on. Gunjan, intellectual, national capital. I think Gunjan, there is nothing like national capital. Pradeep, sorry.
But no, please.
Pradeep Khandelwalji has answered that financial capital, intellectual capital, human, social, relationship, and natural capital. I think he is right to the extent. And Gunjan has mentioned social capital. So I think we have got fair answers other than Jayesh Parmarji, because I think he is expert in this field. Rest have answered fairly well.
Okay. So I think now we go on the integrated framework of SBI, right, Kuldeep ji, and wherein the SBI Life Insurance, where they started presenting this report. All just I wanted to highlight is the value creation model, and how do you eventually quantify all these six capitals. The problem is, so I'll just brief you through this. So this framework is adopted by the International Council, and it talks about the integrated approach of all capitals and adding value in all those capitals, that how this value creation process is happening in an organization. So not only the importance of introducing all these six capitals which learned audience have discussed, but the value creation model corresponding to your business model also needs to come out, and then the output. Kuldeep ji, commonly found error is people define their capitals, talk about intellectual capitals or financial capitals or natural capitals or whatever, but they don't talk about the quantification of these capitals in right way, and the quantification of value addition they have done in right way. But in our sector, in insurance sector, we had this entire process of integrated reporting, I would say benchmark to a maximum extent. But I will want to first come on 2-3 things while we are discussing integrated reporting. One, I think we are discussing about all the value creation model. So when you
I
look
think
at this, the six capitals which we were discussing.
your screen is not visible. We are
Yes,
seeing that. Are you opening the annual report?
you're not able to.
No, we are not able
You
to
are
see
not
the.
able to see
No.
annual
We're not.
report.
No, not able to see the annual.
Just a minute. Now,
Yes, it is visible now.
okay. So now I hope it is visible to all. So this is the value creation model which we were talking about as a part of integrated reporting. Here, what SBI has wrongly done is they have introduced their capital on the same front. The introduction of these capitals and their respective materiality assessment should come on different pages. So first is the introduction, then is the materiality, and then comes the value creation process. Now the inputs which we are talking about. So all these capitals, be it financial, be it manufactured, intellectual, human, natural, or social and relationship capital, needs to be quantified. Now, when you quantify a financial capital, right? So there is a lot of ratios and things which needs to come as a part of your input as well as output. So here, when we say input, we say the equity, share capital, and reserve and surplus. Yes, they are part of your financial capital, but the value creation, and then they have your value creation process, which is not exactly defined the way SBI Life Insurance Company should have defined it. That the entire process, that is not coming out well. But what is coming out well is the output. So what convinces me for showing SBI report is they are able to track the output well. The value creation process needs to be enhanced based on the business practices and how the value chain is created as a whole. When you look at the input, so we say the input here is the equity, share capital, and reserves and surplus. And when you look at the output, here the output comes after the entire value creation process, and these are the most proximate figure one should mention in their financial capitals, be it your gross written premium, be it your PAT, be it your ROE. In manufactured capital as an insurance company, we can definitely the land, buildings, and furniture, fixtures, and the offices. So land and building are not part of manufacturing capital as per IIRC framework. neither furniture and equipments, because they being in a service company. Yes, the number of offices and the capex you make for the entire year should be a part of your manufacturing capital. The output is of a manufacturing capital can be the total number of customers also, can be the number of policies also. They have written it with the way lives covered, right? But when they write the reduction in grievances, they are wanting to highlight the quality of their manufacturing capital. I would want to say, Kuldeep ji, the reduction in grievances has
Mm.
to be a part of social and
Yes,
relationship
yes,
capital.
yes,
So they have
exactly.
just confused it. The
Mm.
problem is that these KPIs for each capital needs to be benchmarked. So, and then comes your materiality assessment and everything, your stakeholder assessment. Now, their materiality assessment also needs to be, drafted in a better way, looking at the IRC framework. Just I have given my audience a overview of integrated reporting. Maybe Kuldeep ji, we will have separate sessions about integrated reporting and everything. My request may be integrated reporting and sustainability.
Yes,
Once
yes,
we conclude
exactly.
this series of webinar,
Mm.
I would
Mm.
want to come out for a specific 2 hour session, because
Mm.
it's a wide area which we have
Mm.
opened up, from financial disclosures to everything. My request here is, Kuldeep ji, I still feel, and I'll put my concluding remarks before I give it to you. I
Mm.
think a lot is looked up to institute when we talk about the quality of financial reporting. The Indian company still stands out amongst the top companies in terms of quality in financial reporting. You compare your annual reports with companies in US having annual reports, I think we have advanced very well. The problem still pertains to be about the compliances in these annual reports. I
Mm.
agree, yes, AR, VR, digitally advanced navigation, yes, they are important things, but I think still when you look at your annual reports, I think somebody has to come out saying, assuring that this is a majorly complied annual report and there is no serious non-compliance which we can see before publishing of an annual report. A constant thrust needs to be given on that fact itself, that before it eventually goes on publication, whatever points we discuss pertaining to accounting policies, pertaining to IRDA, should be very well taken. Kuldeep ji, I would want to say, most importantly, I still feel the mechanism which institute has with regard to the quality is something which gives us a platform. The idea of that, because I received a query from some of the participant that let's come to the topic. So, brother,
Mm.
what is the topic here? So let's then talk about the topic itself. The topic is just not finding a deficiency in accounting standard, or there you have your stat auditors working, you have your teams working, and I hope we are able to highlight that also. But it is about the understanding the entire mechanism from top to bottom. That was the only intent. Hopefully, nobody, hopefully you all like the what we were trying to transform from all fronts. And thank you for your patience listening. And over to Kuldeep ji. It was a wonderful interactive audience, I would want to say. We got
I agree with
maximum
you.
interaction
Mm.
here. Kuldeep ji.
Thank you, Ankit ji, for your deliberation. Ankit ji, what I would like to add one thing to what you have said, that why do we need a constant, process in place to review and to see whether we are rightly complied with, whether we are on the, same page, and we have been benchmarked with the best reporting practices. We always say, as you and we, when we take sessions, we always say that you need to remember just one thing, that compliance is compliance is costly, but non-compliance is fatal. So it is not just about beautification of your annual reports, it is about correcting the soul of the annual report. And for that very reason, there has to be a process in place which constantly reviews and analyzes what is there in your annual report, what is there in your reporting, practices, and correct it at that time only. So with these words, I would like to, place my sincere thanks towards the chairman of the research committee, Dr. Anuj Goyal sir, secretary C. Amit Agarwal, Dr. Amit Agarwal ji, for giving us, me and Ankit ji, this opportunity, and specifically Neha ji, you and your team, that, without any fuss or without any, issue, you are coordinating and organizing programs of this level without any, any sort of glitch or any sort of issue. So I, on behalf of Ankit ji and me, we sincerely place our thanks towards you and your team. Over to you, Neha ji.
Thank you very much, Kuldeep sir. Thank you so much, Ankit sir.
Lastly, if we have some questions.
Yes, yes.
Ankit ji, I think there was.
If we have some questions, Neha, you.
Yes, yes, definitely. We can take up the
Sorry,
questions.
I lost your voice.
Definitely, we can take up some questions, sir.
There was one question from Mr. Khandelwal regarding when we mentioned that the company specific information is required to given in the management report. So Khandelwal ji, it is about, when you see the regulations of IRDA, the schedules, they have prescribed the formats. So it is not about complying with the formats or the language in literal way. It is not about reproducing what is written in the master circular. So we intend to say, when we talk, that company specific information is required to begin. See, the business model, the environment or the financial situation of every company is different. So when you prepare the management report, you need to provide the tables, schedules, shareholding patterns, and other informations according to your company, not just reproduce the language of the IRDA circular. That was our intent when we mentioned that company specific information is required to be given.
Kuldeep ji, one more thing I want to add here. Sometimes we suggest a lot of policy changes in compliance to your, accounting standards or other regulations. My request to all the learned audience here will be that please write those policies which you implement. Sometimes it is found just to be on the face of the balance sheet. We have written that, like Kuldeep ji was talking about, how do you measure the impairment, right? Or the process of measuring the carrying values and everything. There, the actual process of your company should come in place. To have an excellent financial reporting, there have to be excellent accounting policies excellent internal control policies, excellent ERM framework, excellent process of capturing all this information to reach to that level. So that is all I just wanted to sum up. Now, finally, over to Neha.
Neha, I just want to add one thing, that
Sure.
the very reason for organizing these sort of webinars or programs from the perspective research committee is that, see, specifically banking and insurance sector is going to see a major shift in the way they account for the books when the Ind AS will be implemented. And I think sooner or later it is going to be implemented, because IRD has given instructions to companies also that they prepare themselves and they form a steering committee. Fortnightly they review the preparation of how equipped they are to implement the Ind AS 117. So it is going to change the way that we account for specific to insurance companies, and one has to be from company's perspective and auditor's perspective also, because companies will implement, but from auditor's side we need to see whether the law is being complied with. So we are signing a audit report, we are giving a assurance opinion. So again, if we don't follow these things and we don't have knowledge of these things, FRRBs or the NAFRA or any other regulator will come in place. So the point here is to be statutorily complied and present annual report which is good looking, which is relevant for the stakeholders. Ankit, I think you want to add something before Neha ji concludes.
I just want to say one thing. That was the whole idea of telling the regulatory thing. I was slightly disheartened that come on the topic. Over to
Neha.
Neha.
Neha ji, please.
So I would like to thank both the knowledgeable speakers for today's session for sharing such an wonderful insights on the topic of the insurance, which is this year is going to be so much transformative for this insurance sector. So we have almost taken up all the questions also what the participants have asked us. And I would also like to mention to all the participants that this is a series of webinar. Until date, we have covered the manufacturing sector, service sector, banking sector, and this one is the insurance sector. And the next session, which is on financial services, which are other than the banking and the insurance sector, we'll be taking up it on 23rd June. So the timing would be same from 2 to 4 p.m. So we would request all the participants to join on 23rd June with us again. And with this, so if there is no other question, we can conclude with the session. And I would also like to thank to the entire brain behind these series to idealize all these series, the chairman to the committee and C. Anuj Goel sir and secretary to the research committee, Dr. Amit Agrawal sir. So if there is no other question, we can definitely conclude with today's session.
Let's sign off. If you have it, you mail us.
Sure,
And
sure.
all
sure.
the participants, you can connect us through LinkedIn. Bye.
Thank you. Thank you.
Thank
Thank you,
you.
Ankit ji. Bye.